Imagine a ticking clock, counting down to a pretty major economic shift. We've got deadlines just days away that, honestly, could reshape global trade and potentially impact your everyday life. Welcome to a new deep dive. We're digging into a stack of, well, critical sources today, all focused on the latest U.S. tariff policies. Our goal? Pretty simple. Extract the most important insights for you. So today, we're really unpacking the Trump administration's confirmed intent to reimpose high tariffs. We're talking key trading partners like the European Union starting August 1st, 2025. Now, this all hinges on whether bilateral trade agreements get sealed by that critical July 9th deadline. It's coming up fast. You might remember the U.S. initially put on a 10% tariff, then paused it for 90 days for talks. But now they're signaling potential tariffs that could soar, maybe up to 70% for some countries. That's huge. We'll explore the hidden strategies behind this, the impacts direct and indirect on the economy, on your wallet, how financial markets are reacting, and critically, the three most likely scenarios that could unfold and what they mean for major currencies.
Right. And to unpack this, maybe let's start with what the reports are calling the maximum pressure playbook. On the surface, the public message is all about applying intense pressure, right, to achieve what the U.S. sees as fairer trade agreements. Sounds pretty straightforward.
It does, yeah. Sounds like a clear economic objective. But when we look deeper, is it purely about economics?
Yeah.
What else are these sources telling us? Are there sort of hidden motives behind this maximum pressure approach?
You nailed it. Our research, it reveals a much more layered strategy. There are deep political, even geopolitical motives here, not just economic ones. So beyond just trade balance, you see justifications tied to protecting domestic manufacturing, bringing jobs back to the U.S. national security concerns too, like countering China's tech rise, even, believe it or not, stopping Sentinel flow. All these are being sort of pulled in as reasons for this tough stance.
So it's a really broad set of goals then. And it's interesting how the pressures applied. You mentioned the deadlines are clear, but the specific countries, the exact tariff rates, that's all still under wraps. Is that deliberate?
Oh, absolutely deliberate. What's fascinating, really, is this use of ambiguity. Analysts point out Treasury Secretary Scott Bessent specifically said he wouldn't give away the playbook. Which, clearly indicates this is a calculated negotiation tactic. Keep leverage, keep opponents guessing.
Right. And speaking of tactics, is there also a pattern in how these negotiations are happening? Like, are they favoring these one-on-one deals over the bigger multilateral forums?
Precisely. You see a very clear divide-and-conquer approach emerging. The U.S. has already struck individual deals with the U.K., with Vietnam, even an interim agreement with China. It really underlines this preference for bilateral deals, moving away from places like the WTO.
Okay, so connecting this to the bigger picture, this isn't just an isolated trade spat, is it? What does this kind of aggressive unilateral stance mean for the whole global economic order?
Yeah, this is where it gets really, really significant. It's not just trade disputes. It reflects this shifting world order, sometimes called a G0 world.
G0, meaning no single leader anymore?
Exactly. No single power willing or maybe even able to consistently lead the global agenda. And the real insight here, I think, is that the U.S., by pushing its own interests so aggressively, it's not just fragmenting trade, it's actually chipping away at the trust and the institutions, the multilateral ones, that historically stopped smaller disputes from escalating into huge geopolitical crises. It creates a kind of law of the jungle environment.
Like everyone for themselves.
Pretty much. It
Yeah.
forces other nations to act purely in their own self-interest. That risks retaliation, economic fragmentation, and just generally more instability that could unravel, decades of global cooperation.
Okay, so let's bring this down to, us, the individual listener. What about the ripple effect? Let's start with those first-order impacts, the direct hits to the economy. What are the immediate financial costs we're looking at?
Well, the analysis shows a pretty clear immediate negative hit. There's a J.P. Morgan Chase Institute study. It estimates the current tariff plans could add something like $82.3 billion in direct costs, just for a group of medium and large U.S. businesses.
$82 billion. That's a lot.
Yeah.
And who does that affect most?
It impacts about a third of the private workforce, they reckon, especially hitting sectors like retail and wholesale pretty hard.
Okay, a big direct hit on businesses. But, the obvious question then is, don't those costs just get passed on? How does this actually hit consumers, our wallets?
Absolutely, that's the next step. Businesses are likely to pass a good chunk of these costs on to consumers. We've seen studies, Goldman Sachs, the Atlanta Fed, they suggest companies can pass on maybe 50–60% of tariff costs without demand dropping too much.
50 to 60%.
Yeah. And the Yale Budget Lab, they even put a number on it. They estimate these 2025 tariffs could raise general prices by about 1.5%.
1.5% overall price increase? What does that mean for a household budget?
Well, it effectively reduces a typical U.S. household's disposable income by around $2,000 a year.
Wow. $2,000. That's like losing a month's utility payments or a big slice of your family's entertainment budget for the year, isn't it?
It's a noticeable amount, for sure.
So how do the financial markets react initially to this uncertainty, the prospect of these direct hits?
Well, markets hate uncertainty, right? So they react negatively pretty much immediately. S&P 500 futures typically weaken. The U.S. dollar, it often faces some initial selling pressure. But conversely, you see money flow into traditional safe havens, things like the Japanese yen, the Swiss franc, U.S. Treasury bonds. Investors look for shelter there.
Okay, so those are the immediate hits. Now, let's go deeper. To the second and third order effects, these are often more complex, right? What's the most obvious systemic consequence we're seeing?
I'd say the most obvious second-order effect is the disruption, maybe even breakdown, of these global supply chains that have been built up over decades. Companies are basically being forced to restructure their production networks, find alternative suppliers, and that's a really costly multi-year process. It's not quick.
Right. And on that, we hear a lot about the China Plus One strategy. Companies looking to places like Vietnam, Mexico as alternatives. Is that working out? Is it as straightforward as it sounds, or are there wrinkles there?
That's where it gets really interesting. Yes, the China Plus One strategy is definitely accelerating. Companies are moving, but reports are showing these new hubs, they're quickly hitting overload issues.
Overload. Like what?
Well, think severe infrastructure challenges, shortages of skilled labor, major congestion at ports and borders. All these things are limiting their actual capacity to absorb this flood of new investment. So, yeah, it's definitely not as simple as just picking up and moving production.
Okay, not a silver bullet then. And this, I imagine, leads to maybe the most complex impact for financial markets,
Yeah.
the Federal Reserve's dilemma. What kind of shock do these tariffs create for the economy, and how does it tie the Fed's hands?
It's a classic stagflationary shock. That's the textbook term. Basically, tariffs push inflation higher.
Right, because imports cost more.
Exactly. But at the same time, they weaken economic growth because businesses face higher costs, uncertainty. And this puts the Fed in an incredibly difficult spot, a real policy bind.
Because they usually fight inflation by raising rates, which slows growth, or cut rates to boost growth, which risks inflation. But here, both problems are happening at once.
Precisely. And there's already reportedly a deep split within the FOMC, the Fed's policymaking committee. You've got one camp, like Governor Christopher Waller, who seems to believe this tariff-driven inflation is just a one-off thing, something the Fed should look through to support growth.
Okay, look through the inflation. But what's the other side saying?
Well, others, including some regional Fed presidents and Governor Adriana Kugler, they seem more worried about this inflation becoming more persistent, sticking around.
And Fed Chair Powell himself. Has he weighed in?
He has. Jerome Powell admitted that the threat of tariffs is a key reason the Fed remains, in his words, somewhat paralyzed, unable to deliver those interest rate cuts the market expects.
So that paralysis, it removes a key tool the market relies on for stability, right? Which could make any negative trade shock even worse.
Absolutely. It amplifies the potential impact. And then stepping back to the global macro level, this trade conflict just consistently weakens growth prospects overall. Organizations like the IMF, the World Bank, they've already lowered their global growth forecasts. They're warning about increased recession risk.
And beyond the immediate economic cycle, are there longer-term structural changes happening?
Yes. A really significant structural and potentially irreversible third-order impact is this technological decoupling between the U.S. and China. The trade war isn't just about goods anymore. It's deeply into high-tech sectors.
Like semiconductors, AI.
Exactly. The U.S. uses export controls to limit China's access to key technologies. Meanwhile, Beijing is pushing hard on initiatives like Made in China 2025 and leapfrogging to develop its own breakthroughs. What this is creating, potentially, are two separate, competing tech ecosystems, especially in future fields like AI and 6G.
Two separate tech worlds. What's the risk there?
The risk is slowed global innovation, a less efficient world long-term, because you lose the benefits of collaboration and shared standards.
Yeah, that's a huge potential consequence. Let's shift gears slightly and talk about how markets process all this information and uncertainty. George Soros's reflexivity theory seems relevant here. Can you sort of unpack that for us? How do market beliefs actually shape the reality?
Sure. Reflexivity theory is fascinating. The basic idea is that market expectations, especially around something as unpredictable as a trade war, they don't just reflect reality, they actively shape it.
How does that work in practice?
Well, think about it. If businesses fear instability, if they expect a prolonged trade war, what do? They delay investment, they hold off on hiring.
Right, they wait and see.
Exactly. But that very act of delaying investment and hiring itself weakens economic activity, which then seems to confirm the initial belief that, yes, the economy is deteriorating. It creates this kind of negative feedback loop. Fear leads to actions that make the feared outcome more likely.
And this loop can impact policy too, can it? We've seen moments where market panic seems to force governments to backpedal, at least temporarily.
Precisely. Market panic, like we saw back in April when some of this tariff news first broke, can absolutely force governments to temporarily retreat, just to calm investors down. This creates this really unpredictable escalation-de-escalation cycle. Policy decisions end up being influenced by the market's reaction to those decisions. Deutsche Bank actually noted this pattern back in 2018, 2019. They suggested it's kind of an inherent feature of this particular administration's trade policy approach.
So given all that complexity, what's the dominant feeling in the markets right now as we head towards these deadlines? What's the prevailing sentiment?
Well, the news about reimposing tariffs definitely reinforces the risk-off narrative. That's been pretty dominant. All the uncertainty about the scope, the scale, the duration of tariffs, plus the risk of retaliation and the Fed's unpredictability. It just creates an extremely risky environment for investors.
And what are they most worried about? Is there a specific fear that stands out?
Yeah, Bank of America runs a global fund manager survey regularly. And consistently, the biggest tail risk, the thing investors fear most, even if it's low probability, is a trade war causing global recession.
Okay, so risk off dominates. Investors are pulling back from risky things.
Generally, yes. They reduce exposure to risky assets like stocks, commodity-linked currencies, and they increase holdings in safer assets, government bonds, gold, safe haven currencies. However, it's not entirely uniform. That same Beauvais survey in June actually showed a bit of a recovery in optimism compared to April.
Oh, really? So some people are betting things won't get that bad.
Exactly. There's a segment of the market that seems to be betting on more of a soft landing, maybe with manageable tariffs. This contradiction, this oscillation between hope for a reasonable deal and fear of an all-out fight, that's a major source of the volatility we're seeing.
Okay, that makes sense. Let's get specific now about how this plays out in the currency markets, the Forex market.
Yeah.
The US dollar index, the DXY. It's the global reserve currency. But you mentioned opposing forces. How does that actually work? It sounds complex.
It is complex. On one hand, as the global reserve currency, the dollar often benefits from safe haven flows when geopolitical instability spikes. Like in a trade war scenario, that tends to push the DXY up.
So paradoxically, bad news for the world can be good for the dollar.
Sometimes, yes. But on the other hand, if those tariffs really start to weaken the U.S. economic outlook and you have an unpredictable Fed possibly leaning towards cuts eventually, that could pressure the dollar downward.
So a real tug of war for the dollar itself.
Exactly. Its direction isn't straightforward.
What about the USD-CNH pair? The US dollar versus the offshore Chinese yuan. You hear this called a trade war barometer.
That's right. It's probably the most direct reflection, the most accurate barometer of the U.S.-China trade tensions. Any escalation, you see it pretty directly in that exchange rate.
And how might China respond using the currency?
Well, the People's Bank of China, the PBOC, they might allow the yuan to weaken somewhat. It acts as a policy tool, right, to cushion the blow of U.S. tariffs on their exports.
Are there specific levels the market watches for that?
Yes, definitely. Key technical resistance levels, like around the 7.35 to 7.37 area for USD-CNH. The market watches those very closely. They're seen as sort of a red line for Chinese policymakers.
Okay. Now for Europe, the euro versus the dollar, Euro-USD, the EU is a primary target here. How does their response play into the euro's value?
It's crucial. Brussels' response, whether they manage to negotiate successfully or if they retaliate strongly, that will directly impact the euro. If, say, the EU secures a good exemption deal, you could see the euro rebound quite strongly.
But the flip side?
The flip side, a full-blown tariff war would almost certainly weaken the euro significantly, simply because the risk of recession in the eurozone would shoot up.
Makes sense. And then the classic safe havens. The Japanese yen, JPY, and the Swiss francs, CHF. Usually looked at against the dollar, so USD JPY and USD CHF. What happens there when risk-off hits?
Yeah, when that risk-off sentiment really takes hold because of trade war fears, global capital tends to flood into the perceived safety of the yen and the Swiss franc. That causes those currencies to strengthen, which means the pairs, USD-JPY and USD-CHF, actually fall. They're really important indicators of market fear and instability.
Got it. And finally, the Aussie and Kiwi dollars, AUD-USD and NZD-USD, often seen as proxies for global growth and risk appetite.
They really are. These currencies are extremely sensitive to the global risk outlook, global growth prospects. Australia and New Zealand, they're open economies, very reliant on commodity exports, and they have strong trade links, especially with China.
So if China slows down or recession fears rise.
Exactly. When global recession fears spike or worries about China's economy increase, the Aussie and Kiwi dollars are often among the hardest hit, the most heavily sold currencies in the G10 group.
Okay, that gives us a good map of the potential currency impacts. Now let's synthesize all this. Let's look at the path ahead and lay out those three likely scenarios based on the sources. What's the first one?
All right, scenario 1, escalation. We're calling this strong risk off. Our analysis puts the probability at about 45%. The core idea here is simple. Negotiations fail. The U.S. goes ahead and imposes high, broad tariffs, maybe 20%, 50%, even more, starting August 1st. And then, crucially, China and the EU retaliate aggressively, with equivalent tariffs, maybe non-tariff barriers too.
Like what kind of non-tariff barriers?
Things like limiting exports of critical materials like rare earth elements, or maybe adding big U.S. companies to an unreliable entity list. Things that really bite.
Okay, so a full-blown trade conflict. What does that do to markets? And specifically the currencies we just discussed.
In that scenario, you'd expect global financial markets to, frankly, panic. Volatility spikes, think the VIX index shooting up, stock markets would likely plummet, expectations of a global recession would surge, and the Fed, still paralyzed, unable to cut rates because of the inflationary pressure from the tariffs, even as growth tanks.
And the FX impacts.
Pretty clear. USD-JPY and USD-CHF would fall sharply, that safe haven flow kicking in strongly. AUSD and NZD-USD would get hammered, falling very sharply because of the global recession fears and the China slowdown aspect. USD-CNH would surge upwards, likely with the PBOC letting the yuan weaken past those key levels, and UOD would fall sharply too due to the Eurozone recession risk.
When would we feel the main impact of this?
The strongest impact would likely be in the midterm, say 1 to 4 weeks after it's confirmed this is happening.
And what are the signals we'd look for to confirm scenario 1?
Key signals would be an official announcement from the USTR confirming high tariffs on the EU, the EU publicly announcing its retaliatory measures, and watching USD-CNH decisively break above that 7.37 resistance level.
Okay, that's a pretty sobering scenario. With a 45% chance, what's the second possibility?
Scenario 2, limited agreement. Let's call this cautious risk on. We estimate the probability here at around 40%. The idea is that maybe last-minute pressure from markets freaking out, from domestic businesses lobbying hard forces the parties to reach some kind of deal. Maybe a temporary one or an agreement in principle.
What would that look like? A compromise?
Yeah, basically. The U.S. agrees to maybe a more manageable basic tariff level, say 10-15%, instead of those really high numbers, and crucially provides important exemptions for sensitive sectors, like maybe cards from the EU.
Okay, a partial deal, some relief. How would markets and currencies react then?
Well, you'd expect a big sigh of relief across global financial markets. Cautious risk-on sentiment would return. Concerns about that tariff-driven inflation would ease significantly, which could potentially open the door for the Fed to actually consider rate cuts later in the year, assuming the economic data supports it.
And the currency moves in that case, almost the opposite of scenario 1.
Pretty much the reverse, yes. USD-JPY and USD-CHF would likely rise as that safe haven demand evaporates. AUD-USD and NZD-USD would probably recover quite strongly. USD-CNH should fall significantly as tensions ease, and USD would likely rise sharply as those tariff risks are taken off the table for Europe.
What about the overall dollar, the DXY?
The DXY would probably fall sharply, both because of the general risk-on mood and because expectations of a more dovish Fed, potential rate cuts, would increase.
Timing and confirmation signals for this one.
Again, likely short to midterm, 1 to 4 weeks. Confirmation signals would be things like a joint U.S.-EU announcement talking about an agreement in principle, the USTR confirming key tariff exemptions for important industries, and maybe seeing the VIX index, that fear gauge, fall back below 15.
All right, so escalation at 45%, limited agreement at 40%. That leaves 15% for the third scenario. What is it?
Scenario 3, prolonged uncertainty. We're calling this sideways complex. Estimated probability, as you said, 15%. Here, instead of a clear win or loss, the U.S. just kind of kicks the can down the road, extends negotiation deadlines, maybe apply some tariffs, but selectively, vaguely. It creates this sort of lingering environment, no major blowup, but no final resolution either. It just maintains this uncertainty tax on the economy.
So basically limbo, an ongoing state of wait and see. What does that do to markets?
Well, markets lack a clear trigger, a clear direction. That uncertainty still weighs on long-term investment decisions, but there's no immediate prices to react to. Investors probably get fatigued, cautious, trading volumes might decline. Major assets like currency pairs could just move sideways in relatively narrow ranges, waiting for the next big headline or piece of economic data.
And the Fed in this scenario?
Still likely in wait-and-see mode. No strong reason to move rates either way. Forex markets, in this case, would probably be driven more by the day-to-day economic data releases, CPI inflation numbers, non-farm payrolls, job reports rather than trade headlines. Major pairs like USD, USD-JPY, AUD-USD, USD-CNH might just oscillate without a strong trend.
How long could this last? And what confirms it?
This could drag on midterm, weeks, maybe even months. Confirmation signals would be things like an official White House announcement extending negotiation deadlines again, and crucially, no major large-scale tariff actions actually taking effect on August 1st.
Okay, 3 distinct scenarios. Escalation, limited agreement, prolonged uncertainty. Between those, based on everything we've discussed, what does the analysis suggest is actually the most likely outcome as we approach this July 9th deadline?
While weighing it all up, our analysis does lean towards scenario 1. Escalation, strong risk-off, being the most probable, with that 45% likelihood.
Why that one? What's the main driver pushing towards escalation?
It's primarily driven by, well, the internal political logic, particularly in the U.S., and just the inherent nature of brinkmanship negotiation. This administration's trade policy, based on past actions, often seems fueled by a desire to project toughness, to secure clear wins that resonate with domestic voters. Backing down without getting significant concessions from the other side could easily be portrayed or perceived as weakness.
And the other side, the EU and China.
Exactly. Simultaneously, both the EU and China have their own domestic pressures, their own red lines. They're unlikely to just accept what they see as, surrender under duress. So you have this combination. One side determined to exert maximum pressure and others unwilling or unable to yield beyond a certain point. That creates a really high probability of miscalculation, of retaliatory escalation.
Are other analysts seeing this risk too?
Yes, leading risk analysis firms, like Eurasia Group, for instance, consistently highlight a U.S.-China breakdown as one of the top geopolitical risks. It feels like the market might actually be underestimating this possibility right now.
Okay, so if scenario 1 escalation is the most likely, what are the strategic takeaways for our listeners? If they're trying to navigate this, what kind of approach should they consider?
Well, based on that likelihood, a defensive posture makes sense. A risk-off strategy seems advisable. Practically, that might mean considering short positions on those risk-sensitive currencies we talked about, the Australian dollar, AUD, the New Zealand dollar, NZD.
Any specific levels for those?
Well, for example, one potential area to watch for selling AUD-USD could be if it fails to break above the 0.6750 level. The potential target on the downside in an escalation scenario could be down towards 0.6300 based on some technical analysis. But these are just examples, of course.
Great. And for those looking for safety, where might they look?
You'd look towards long positions in the traditional safe haven currencies, the Japanese yen, JPY, the Swiss franc, CHF, likely against the US dollar. So for instance, you might consider selling USD JPY if it approaches the 146.00, 147.000000, potentially targeting a move back towards 140.00 if risk aversion really kicks in.
And what about trading the China relationship more directly?
Trading the USD-CNH pair is the most direct way to express a view on US-China escalation. A long position there, betting on the dollar strengthening against the yuan, would look particularly interesting if the pair decisively breaks above that key technical resistance we mentioned, around 7.37.
Okay. And you mentioned options earlier as a risk management tool. How could they be used here? What kinds of strategies?
Options can be smart because your potential loss is limited to the premium you pay. So in a risk-off scenario, you could consider buying put options on stock market indices like the S&P 500, or puts on risk-sensitive currency pairs like RGUSD. These gain value if the underlying asset falls.
What about betting on volatility itself?
Yes, buying call options on the VIX index, the volatility index, is another effective hedging strategy. If markets panic, volatility spikes, and those VIX calls would increase in value. And some sources suggest that the implied volatility, basically the cost of options for USD-CNH, is still relatively low right now. That might make options a potentially cost-effective way to position for turbulence.
Of course, every analysis has its blind spots. We have to consider the unexpected, the black swan events that could just throw all this out the window. What are some of those possibilities we should keep in mind?
Absolutely crucial to remember those. A few possibilities come to mind. One is just a sudden, unexpected U-turn from the U.S. president. Maybe a tweet declaring, "We have a great deal," out of the blue. That could instantly change the market mood.
Okay, a political surprise. What else?
A major geopolitical event elsewhere? Think military action in a hotspot like the Taiwan Strait. That would likely overshadow the trade war entirely, trigger a much larger wave of risk-off sentiment, and could actually boost the US dollar significantly, despite the trade issues, just due to its ultimate safe haven status in a crisis.
What about actions from China?
Well, there's the possibility, though probably unlikely, of some kind of asymmetric intervention, like China deciding to sell a large chunk of its U.S. Treasury bond holdings. That would cause a massive shock to global interest rates.
Or maybe problems within China?
Yes, a serious financial crisis unfolding within China itself, maybe related to their local government debt issues or the real estate bubble finally bursting. That could lead to unpredictable global contagion effects.
Any chance the central banks step in?
That's the last one I'd mention. Coordinated intervention by the major central banks, the Fed, the ECB, the Bank of Japan. If markets really started to panic severely, they could activate things like currency swap lines to pump U.S. dollar liquidity into the global system. That could potentially calm markets much faster than expected. And always remember that complex matrix of how the Fed might react depending on which tariff scenario plays out and what the underlying economy is doing with inflation and growth. That's really a crucial, more advanced tool for understanding where the U.S. dollar might ultimately go.
Right. Well, we've certainly covered a lot of ground today. We've taken a really deep dive into this latest U.S. tariff policy situation, peeled back the layers of strategy, looked at the economic impacts far and wide, dissected how markets are reacting, and laid out those three key scenarios, plus what they could mean for your investments and really the whole global economy. And as we wrap up, thinking about these potential major shifts in trade policy and global relationships, it does raise a pretty big question, doesn't it? This aggressive pursuit of national interest, this potential move towards a G0 world. What does it truly mean for the future of international cooperation, for economic interdependence, not just for the next few months, but maybe for the next decade and beyond? Something for all of us to mull over